Hey everyone, Brennan Ruby here. This is Compound Thinking. I'm trying to become a better value investor in a modern investing world. I've only got about 15 or 20 minutes before I have to get back to my real job, so let's talk about Barrick Mining, a company who I love, but is it priced to perfection? Gold has been above $3,000 an ounce for 13 consecutive months, above $4,000 for 8 months, and Barrick Mining, the second largest gold producer in the world, is trading at $43 a share, which is lower than it was at the end of last year. Also when gold was lower. While I'm a long-term gold and silver bull, I do think it's important we look at the current price and how it relates to its current value. A quick disclaimer before we get into it, I am not a licensed advisor. I'm not telling you what to buy. This is me showing you my personal process and how I valued Barrick in hopes that it adds value to your own process. Do your own research. Talk to a real advisor if you're investing meaningful money that knows your situation and your goals. I should also mention that my last analysis was done almost a week ago from recording this video. While the fundamental analysis hasn't changed, the stock is currently sitting below $40 versus $43 at the time of the analysis. Just keep this in mind as we talk about anything related to the price of this stock or of gold. Gold has been on a generational run over the last year or so. It bottomed in 2022 around $1,800. It crossed $3,000 in March of 2025. It crossed $4,000 in October of 2025, and then it peaked in February of this year at $5,247. It's since pulled back to about $4,500, and it's just been chopping around that number ever since. That's a 13-month bull run, with the last few months of it looking more like a consolidation than a top. For a gold miner like Barrick, that's a massive operating tailwind. Trailing 12-month free cash flow is over $5 billion. Net cash is sitting at $2.4 billion, up from net debt of about $1 million just 15 months ago. And that position is growing roughly $700 to $900 million per quarter after the dividend. Gross margin is above 60%. The cash machine is running, and it's been running for over a year. That changes how we look at the earnings power of this company in general. Before we talk about the business, we have to understand what really drives short-term price action. Barrick is a bet on gold with a corporate logo attached to it. The equity moves about 2 to 3 times what the metal moves in both directions. So if we don't have an opinion on where gold will go in the future, we can't properly value Barrick itself. I'm a long-term bull on gold, and the structural drivers there are real. Central banks are buying about 1,000 tons a year. De-dollarization momentum is picking up. Real rates keep getting compressed, and the mining itself is inflating, which means the price of gold for miners to make money has to go up as well. So all of these things would suggest that gold is headed higher in the future, but that's not a guarantee that short-term price movement matches that. I don't know that $5,000 forever is where we're headed in the near term. Whatever I say next about valuation, hold it very loosely. The single biggest variable in this stock is the metal itself. Okay, so here's my verdict. I need to mention one thing before we dig in, because I already feel like gold enthusiasts are going to let me have it in the comments section. I'm approaching this from a very conservative value investing standpoint. I can almost guarantee I'm too pessimistic about the future price of gold. If you disagree with me, then you can easily take my scenario analysis later in the video and adjust the percentage chance of each happening to what you believe matches reality. It's entirely possible to make this look like a value or a trap just based on the weights you give each possible outcome for the price of gold. Okay, so here's where I landed. My probability weighted intrinsic value comes out to $29. The stock currently sits at $43.41, so that's a 48% premium. The premium, like I said, has gone down because the price has gone down, but it's still overvalued based on my intrinsic value. It's meaningfully above what I think the business is worth if you normalize for the price of gold, not what the price of gold is today. The verdict to me is a hold for anybody that has a current position, and it's a pass for anybody looking to initiate a position at this current price. A full position for me, so if you were to get the entire full position of 5%, I would say it would need to be closer to around $20.50, which would require a huge reversion in gold. And today, the market's just not pricing that in. The investment score for me is a 5.6 out of 10. It is a good business. It's just at the wrong price. It has improving fundamentals, a fortress balance sheet, but the price doesn't reflect a base case view of long-term gold. It reflects a bull case view. A quick refresher on what Barrick actually owns. So it's the number 2 gold producer globally, processing 3.47 million ounces per year. 80% of that is gold and 16% of that is copper. So I guess they produce 3.47 million ounces total a year. So apologies. 80% of that is gold and 16% of that is copper. The crown jewel is Nevada Gold Mines. It is a joint venture with Newmont. Barrick owns 61.5% of that. There's 4 mines there in the best gold basin on Earth in the safest jurisdiction. Next door to that, Barrick owns 4 Mile outright. That's 15.6 million ounces at 16.9 grams per ton, 5 to 8 times the grade of Carlin. It's arguably the best undeveloped gold asset in the world, but first production isn't scheduled until 2032. So that does provide a long-term moat for Barrick, but is not actively adding to the financials at this current moment. All right, so if we look at the chart, revenue, free cash flow, and return on invested capital over the last decade, paired with the actual average gold price overlaid into it. Here's the pattern. Gold was flat from 2016 through 2022 in the 12,050 to 1,800 range, and it stepped up in 2023, lifting off to about 2,400 in 2024, and then it averaged about 3,500 for the full year of 2025. The trailing 12-month ending Q1 gold price for 2026 was $4,000 an ounce. But if you look at the 10-year average return on invested capital for the company, it's 2%. The current 21% annualized return on invested capital is entirely tied to the price of gold doing the work, not the business getting more efficient. But here's the part that matters. The gold work has been in place for over a year. This isn't a one peak quarter. It's a 12-month run rate of elevated gold flowing through the income statement. That makes the earnings power more durable than just, say, a one-quarter spike with a reversion immediately after. Is the value real? This is the most important side of the question. There is a classic trap with commodity stocks where they look the cheapest right before they get crushed because the cycle peak inflates earnings, deflates PE, and then commodity mean reverts. So I will always ask, is the value real or is this a peak cycle illusion? Barrick at $43 sits at the 21st percentile of its 33-quarter trailing price to intrinsic value. Bottom quartile cheap is on the screen itself. The question is whether or not the denominator, trailing 12 months earnings, is artificially inflated. And the answer is no. The trailing 12 months earnings were generated over 4 consecutive quarters of sustained 3,000 plus gold. Average trailing 12-month gold was about $4,000. That's not a one-quarter spike. It's a run rate of the current bull run. Within the sustained elevated gold era that started in Q2 of 2025, the median price to intrinsic value is 1.18. The current reading is at 1.1. The stock is modestly cheap within its own current bull run history. While above its intrinsic value, it is below the price investors have historically paid for this company. There's 3 risks that I think we need to talk about. One is the gold mean reversion. Still the dominant variable, and the math is brutal once you anchor honestly. A $3,000 long-term gold, the stock is worth about $22, a 49% drawdown from the current price. At $2,500 gold, it's worth about $13, which is a 70% drawdown, and at $2,000 gold, which is where metal was actually 3 years ago, it's worth somewhere between $5 and $10, close to an 80% loss. The probability of a greater than 30% decline in gold over 5 years, in my opinion, is around 35%. That's a meaningful tail. The equity is leveraged 2 to 3 times to the metal, so even a modest gold reversion turns into a severe equity drawdown. I think it's a good time to reiterate the likelihood of gold dropping back to 2000 is very low, but a move of that magnitude has happened as recently as the 80s and 90s. So using this analysis as my anchor, I'm able to tweak scenario probabilities and make educated investment decisions on Barrick itself. The second risk we need to talk about is Reko Diq in Pakistan. The construction contractors there filed a force majeure notice on security grounds. They're legally declaring the site is too dangerous to work at. I'm carrying about a 42% probability that the project never reaches commercial production or there is a $1 to $2 billion write-down. The last thing I want to talk about is structural cost position. Barrick's Q1 2026 all-in sustaining cost was $1,708 per ounce per the company's own May 11th earnings presentation. Agnico Eagle is widely regarded as the lowest cost operator in the senior group, and while I don't have a specific number for them, I know that there is a gap and that Barrick is more mid-class when it comes to their peers in terms of the cost, the sustaining cost of getting the gold out of the ground. At $4,700, nobody really cares that your sustaining cost is $1,700, but if we approach $2,500 gold, it becomes much more of an issue. Obviously, closing the gap would happen significantly if the 4 Mile is in production in 2032 and it's as good as it looks on paper. My honest admission is I have the least visibility into the price of gold itself. I can frame probabilities, I can forecast levels, but if long-term gold averages $2,500 instead of $3,500, my valuation is wrong by a wide margin. If it averages $4,000, my valuation is quite light. Before I go further on evaluation, I want to be careful about one thing because I think a lot of finance writing trips over its language here. People hear downside and read it as the company goes to zero. For an operating business with $5 billion free cash flow, $2.4 billion of net cash, and 24 years of proven reserves, going to zero is a very low probability event. Break the downside. So I break the downside into 3 categories. Bankruptcy, where the equity goes to zero. For Barrick, that's an under 2% chance in over 5 years. There's the permanent thesis break. So look at the stock minus 50% or worse with no recovery over the next 5 years. To me, that's more of an 8 to 12% chance. And then mark-to-market drawdown. So this is where the stock is underwater at any point after making the buy decision, with which it may or may not recover from. That, to me, is about a 30 to 40% outcome for this gold miner, given the volatility of the commodity. If you own a gold miner, you have to be willing to ride with the third row to participate in the upside. The first row, actual capital destruction, is genuinely a small outcome, small percentage chance outcome. All right, I did 5 methods to actually value the company, and it's all anchored to my probability-weighted expected gold price of about $3,500 per ounce over 5 years. The conservative methods I had, discounted cash flow, enterprise value over EBITDA, free cash flow yield, PE, produce anywhere from $12 to $35 per share at the base case of $3,500 gold. If you look at the net asset value at 1.1 times the price, or price to net asset value, that does produce around $43, which is where it's trading at today. If you method weight my intrinsic value at the base case, it lands at about $31. But if you run all those same methods across the full distribution of 6 gold price scenarios and you include the extreme bear side of things, I come up with a value of closer to $29. So I think there's a range here where the intrinsic value of the company could be anywhere from $29 to $31 at the current moment. Now, if you take the reverse discounted cash flow to cross-check what the market is actually pricing in today, at today's $43.41, the market is implying pricing gold at $42.65 long-term. That's about $700 above my expected $3,500, and it's only a 9% drop from today's spot price. So the market is basically saying we are not going to see a crash at all in gold. We may see a 9% consolidation to $42.65, but they more on believe that's the new long-term floor. I'm not making that bet given my assumption of $3,500, but if you are, today's price looks fairly valued instead of being expensive. So for those 6 scenarios over 5 years, the probabilities I am working with are on the screen now. Probability weighted 5-year total value comes out to about $36, which is below today's $43.41. The implied 5-year IRR from a $43 entry is negative 3.5% annualized. That's not a positive expected return. That's a situation where you're going to have less money in 5 years than you do today based on my analysis. Only the strong plateau and the continued strength scenarios together, which is about a 27% probability, generate stock prices above today's. The other 73% leave a fresh buyer at today's prices underwater. I do want to clarify one thing very quick, though. I'm using 2 related numbers in this piece, $29 and $36, and they answer different questions. $29 is what I think the business is worth today, probability weighted across all the gold scenarios. That's the anchor when I think about margin of safety. At $36, this is what I expect to have in 5 years if I bought today and held. So that's the 5-year stock price appreciation plus the dividends collected. And again, that's weighted for all the different scenarios. Both numbers sit below 43.41, so there really isn't a way that I see this being a value at the current moment. I do believe that it's overvalued given the most recent run in gold. All right, so let's talk about action levels. Where would I be buying? Where would I be trimming? This is my framework for my portfolio. It's not a recommendation for your own situation. For me, a strong buy would be under 1750. That's a 40% margin of safety. We would need a real gold reversion for that to happen. I would buy a full position anywhere under $20.50, which would be a 30% margin of safety, and that's a risk profile that I like for a commodity stock like this. I would be willing to accumulate as a starter position under $26, and I would pretty much hold from anywhere between $26 to $33, give or take 10% just based on the current situation and how I feel gold is moving. I would start to trim above $36, and I would exit or avoid this altogether at $43, which we were at the time of the analysis. Position size cap, still 3 to 5% of the portfolio regardless of conviction. The commodity stocks always get a sizing constraint for me. The sizing rule is really the only real protection if you're completely wrong on your call for the commodity itself. At the end of the day, Barrick is a narrow moat commodity business with a structural cost position that's in the middle of the pack of its peers. It's sitting in a year-long gold run that has produced genuinely impressive free cash flow. The Q1 numbers are real. The balance sheet is fortress grade, and management has now delivered 2 consecutive quarters of meeting commitments. It's a meaningful inflection given the historical Barrick discount that we've seen. At $43.41, the stock trades 48% above the $29 intrinsic value, and for me personally, it's a hold. I've held what I've already bought, but I'm not adding any fresh capital here. A full buy for me again needs to be around $20.50, which would require a huge reversion in gold at the current moment. Could I be wrong? Yes. If gold averages above $3,500, there's likely no major buying opportunities ahead. But to me, this is a golden company priced to perfection. If this was a useful video, please subscribe. I have linked a full write-up in my Substack, linked below. You can also find reports there that I'm not going to be doing video or write-ups on, but I am going to post full analysis on my Substack. So if you want to get access to those, especially for smaller, more niche companies, feel free to follow me and subscribe on Substack. But tell me in the comments if there's any stock you want me to review that you're currently looking at as well. So thanks again if you've made it this far, and I'll talk to you soon.